Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from Canadian tax proposals to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. The Pillar 2 engine from PwC is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this centralized rules engine is built by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and will be licensable in July 2024. On this week's episode of Cross-Border Tax Talks, we're back in PwC's Policy on Demand studio in Washington, D.C., where I'm excited to be joined by Ken Buttenham. Ken is a Toronto-based international tax partner and the leader of PwC Canada's International Tax Services practice. Ken, welcome to the podcast.
Thanks, Doug. Great to be here.
So we have got an action-packed podcast for us, a lot going on in Canada. I think this might be the first kind of official Canadian cross-border tax talk, so I'm really excited to have you on. But before we dive into the Pillar 2 proposals, your digital service taxes, interest limitation rules, and your latest GAAR, I have an important question for you about my favorite food in Canada, poutine. So for those not familiar, poutine is essentially potato French fries topped with cheese curds and smothered in thick brown gravy. It melts the cheese, it's delicious. From some extensive internet research, I learned that the dish originated in Warwick, Quebec, by a restaurateur named Fernand Lachance. I'm sure I didn't pronounce that appropriately in France, or in French. So as a Toronto native, do you have issues with it being considered the country's national dish? And do you have a favorite poutine spot in Toronto for listeners?
Well, Doug, I think you've managed to find the one of a few people who doesn't partake a lot in poutine. At my age, I gotta be mindful what I'm into.
I understand.
But it is huge, and it's not just as you described. This weekend at my cottage there was a poutine festival, believe it or not, with food trucks, and you wouldn't believe what they're doing to poutine nowadays. So you'll have to come up.
All right, I definitely need to check out the poutine festival. I'm going to put that on my calendar. All right, well, let's dive into some much more substantive topics on Canada. And I think we first have to start with Pillar 2. So on August 4th, 2023, Canada unleashed a variety of proposals, including what they're referring to as the Global Minimum Tax Act, or the GMTA. Tell us a little bit about what was introduced, and we'll kind of dive into some of the specifics.
Yeah, so finally, Canada's hopped on the Pillar 2 boat. And there was some question when we were first talking about what the rules were going to look like, as to whether Canada was going to try to integrate the rules into our existing act. It turns out, like you said, they have brought out an entirely new act, which brings with it its own administration, its own charging provisions, as you'd expect, its own definitions, etc. So that and of course a new acronym, because you can never have too many acronyms in the international tax world. So So the Global Minimum GMTA. It follows very closely to the model rules. Not a lot of exceptions. We've Canadianized it, I would say. So one thing we've learned is that the way the rules have been put together are slightly different than the model rules are laid out, and some of the definitions are Canadianized, as I call it.
Okay.
It's worth going through some detail to look at how those rules will impact.
And so what generally did they introduce? So we have an income inclusion rule, qualified domestic minimum top-up tax, but there was a placeholder for the UTPR. Maybe talk a little bit about those, what effective dates and what information are we still lacking? Yeah,
absolutely. The UTPR, I'll start with that just because maybe that's what was not included was the UTPR, but there's a placeholder. I think we're going to talk a little bit more about the UTPR later, but the IIR and the domestic minimum tax, which is not technically qualified until the inclusive framework, I guess, says it's qualified, but it's clear the intent is it's going to be a qualified domestic minimum tax. They're both going to be effective for Canada. Followed the inclusive framework wording from way back in 2021. It's for taxation years beginning after December 30th. 2023, which effectively for calendar year taxpayers will be 2024.
Assumption that the UTPR would be the following year.
Yeah, so that is the assumption. That's going by what the finance has said publicly. I know there's been some talk, especially in the US, around the UTPR safe harbor that's been talked about, and whether Canada's going to join on with that to defer it another year. I think we have to wait and see when the UTPR rules come out to see what Canada's going to do with that. But that's the plan right now.
Okay, and I want to unpack that a little bit too, with respect to kind of particularly the latest administrative guidance. But before we go there, maybe talk a little bit about in context, how does the Canadian legislative process work? This has been one of the most interesting things about kind of following Pillar 2 is understanding how your legislative process works. And so when will these rules, so we know that the intended effective date is, for all intents and purposes, January 1st, 2024 for the QDMTT and the IER, but tell me a little bit about how that process works and when we'll actually see legislation kind of formally passed.
Yeah, absolutely. And this is a bit of a crystal ball question, but generally we have a parliamentary system, and generally in the fall, the government will introduce one tax bill, and they try to capture as much in there as they can that needs cleanup for the year, and they'll pass it before the end of the year. Now, the interesting part about the October 4th release, remember I said there was, well, you mentioned there was a release of a ton of legislation, like 350 pages of legislation. The Pillar 2 rules being one part of that. The comment period for all the rest of the stuff was September 8th. And the theory is, or the thought is, that makes sense given the timeline. They will get comments, they will incorporate it into a bill, they'll pass it when they can get back from summer recess in the fall. The interesting part to note about Pillar 2 is the comment period runs till September 29th. And that is an indicator, I think to me at least, that it's probably not likely we're going to see Pillar 2 legislation enacted before the end of the year. And that usually raises the question, well, when will it be enacted? We don't know, but if it goes into next year, there's some difficult or some challenging accounting questions to answer right around if it's not substantially enacted by the end of the year, what does that mean for disclosure, et cetera? If it
particularly under the IFRS standard,
correct,
which does require
some
disclosure this year.
Yeah. And what if it's not substantially enacted by Q1 2024, right? Then companies are going to really need to think about what has to be, they can do.
And under Canada's rules, like you can, even though it's not enacted until some point in 2024, it could still be effectively retroactive to January 1st.
Yes, it'll definitely be effective as of December 31. And unfortunately, in the Canadian system, we've seen that a lot lately. Our first tranche of our hybrid mismatch rules were actually effective July 1 last year, but we still do not have enacted rules. We're going to be talking about our interest limitation rules and the dynamics around that. So it's not unusual in Canada. Well, it hasn't been unusual lately to have rules that haven't been enacted, but they're effective.
All right, and then once those rules are enacted, and we'll unpack sort of what was kind of included in the most recent administrative guidance that came out in July 2023 and what's not, how does it work in Canada with respect to both referencing or incorporating existing administrative guidance, kind of interpretive guidance, and then what about future guidance that comes out? And is there a meaningful difference between something that may be interpretive versus a meaningful change of a law?
Yeah, so there's the release, the Global Minimum Tax Act, has an interpretive rule that says it should be interpreted consistent with the model rules, the commentary, and any guidance, current or future guidance, I believe, is what it says. But the question that you're getting at, I think, is if in the future there's substantive guidance that comes out that actually changes the tax situation, how is Canada going to deal with that? Canada they've also said in the new rules that they can bring out regulations, but that can only go so far. So the question as to whether, similar question in other jurisdictions, as to whether Canada can avoid going through Parliament to change the rules to incorporate changes, significant changes to the Pillar 2 model rules, is something that we're going to have to watch. Right now, they think they can. It looks like from the interpretive rule that they're going to follow the guidance and see how it plays out, is how it seems.
Yeah, it's going to be a real challenge for countries. We've mentioned this on the podcast before. I mean, the latest example was that there was some news based on a conference, and some of the working party members of the OECD had talked about introducing, for example, some type of anti-abuse rule in the context of the country-by-country safe harbor. Mm-hmm. And of course, it begs the question of, well, they said that they were going to address that in September. When do those rules come out? How do they get incorporated into various domestic legislation? Because it would seem to me that some sort of anti-avoidance rule would not really be interpretive. It's more a substantive change. Right. And the question is, how quickly can the OECD get out the next round of administrative guidance? And then how does that get incorporated into domestic legislation? And I think that there's obviously a gray line between interpretive and substantive difference, but a lot of many of the open questions that we have are frankly more substantive than interpretive, although there's plenty of both, for sure.
That's right, and if it goes back to the question on when we're going to pass the bill, the longer Canada defers actually enacting, the more of that stuff it can incorporate, but same issue going forward, right?
Right. So you had mentioned that the rules generally follow the OECD guidance. One of the things that I found interesting from going through the rules, and I do, these are a lot easier to go through in English than some of the other, like the translation that I've tried to do in some of the other countries. But they did include the permanent qualified domestic minimum top-up tax safe harbor, which was a concept that was introduced at the most recent administrative guidance. So that was just like a week or so after those rules were proposed, or the administrative guidance was released at the end of July, and then obviously August 4th. Yep. But there were a whole number of things that you already mentioned. One, the UTPR safe harbor, which many U.S. multinationals are very focused on, with the possibility of potentially subsidiaries of U.S. MNCs collecting the top-up tax. To remind listeners, the administrative guidance had suggested that the UTPR safe harbor would apply specifically to the U.S. or for countries that have a greater than 20% tax rate, which obviously was targeted to the U.S., but there would be a safe harbor till 2026. One of the other interesting things that I did not see in the Canadian rules was the ability for countries to potentially do their qualified domestic minimum top-up tax, and for it still to be considered qualified if it relied on local stat as opposed to the financial accounting system of the ultimate parent entity. And the reason I think this is very interesting and would love your comments on this is that I think there's going to be a real challenge for taxing authorities trying to audit, for example, QDMTTs, particularly in Canada, as an example, where if the ultimate parent entity is based on US GAAP, I mean, how much experience do these taxing authorities around the globe really have with US GAAP? And so I can see the appeal for jurisdictions to say, well, we'll do local stat, frankly, just from an administrative simplicity for the taxing authorities to be able to handle that and be able to handle those reviews. But any insights from a Canadian perspective, or is this just we're going to have to wait and see?
Yeah, I think it's mostly a wait and see. I mean, I have a lot of thoughts on the issue you've talked about. I think it is an issue. I think it's going to be interesting. I think the hope is, there's a lot of questions unpacked there. It's probably a separate podcast.
That's true.
I think right now, Canada is going to be basing its QMT or domestic minimum top-up tax on the accounting of the UPE based on the draft rules, but we'll see. I think that's going to be a challenge.
Yeah, we'll see how that shakes out, and to the extent that jurisdictions choose to do a QDMTT with local stat, well, we know we now have this permanent QDMTT safe harbor, so that turns off the IAR. But obviously, the base of those calculations could be significantly different if you're applying, for example, IFRS at the local stat and US GAAP at the ultimate parent entity, which frankly just makes the complexity of those calculations even more, because we know the QDMTT trumps. That's where taxpayers are going to have to start, and certainly makes the calculations even more challenging, even if they're basing it on the model rules, the QDMTT on the model rules and commentary. If the underlying accounting is different. Those can be very, very different answers.
Canada likes consistency, so I would say, the idea of taxpayers being able to choose what accounting they use, depending on what they're calculating, will probably not be very popular in Canada, in most countries. So I think that's wait and see.
Okay, I want to get your thoughts on a couple of things that did not appear to be included, and correct me where I go wrong. The first was, you had mentioned this is a separate tax act, and you already have your foreign affiliate rules, which you have educated me on over the years. How do these, the Global Minimum Tax Act and the Pillar 2 rules kind of interact with the existing rules in the Canadian Income Tax Act?
Yeah, that was a bit of a surprise because I know from discussions with finance they've been talking about or thinking about what I call them consequential amendments may be required to the Income Tax Act as a result of Pillar 2. The two areas that come up the most are our CFC rules, we call them our FAPI rules, and making sure we integrate the ability to get relief for domestic minimum taxes in foreign countries, because that they now stand in front of CFC taxes. So there's some changes that will be required to our FAPI regime to deal with Pillar 2. The other one is also, you may know that, or you may remember that Canada doesn't have a exemption regime for foreign income, right?
Very well.
We have a quasi, I guess, exemption system where the treatment of the dividends received from CFCs depends on the surplus pool, the character of it, what it's paid out of. And the Pillar 2, we're going to have to change our surplus rules or amend them to deal with Pillar 2 taxes also. So that's another area.
All right. What about, so a big interest in the U.S. has been tax incentives and whether something qualifies as a qualified refundable tax credit. In the most recent administrative guidance, it seemed to put some of those issues to bed with respect to the Inflation Reduction Act and some of the CHIPS Act credit. What's the landscape look like in Canada? And I'm particularly interested in R&D, and is there any guidance or thoughts on whether some of the incentives that you tend to offer in Canada could be considered qualified refundable tax credits or marketable tax credits?
Yeah, so no marketable, but generally I understand that our refundable tax credits in Canada, mostly relating to R&D, will be qualified. The problem is the refundable ITC rules for R&D is generally only applicable to the smaller Canadian-controlled private corporations, the types of corporations that Pillar 2 won't apply to. So there is a separate, I don't know if a consultation is the right word, R&D consultation starting or just underway. And I know they're considering on the incentive side, does Canada need to take another look at how it does things? I don't know what's going to come of that. It's a huge lift, but wait and see.
I mean, obviously the same issue that U.S. Authorities, regulators, legislature is going to need to consider is how does now Pillar 2 really impact these domestic incentives? Particularly R&D seems to be the one that is a big issue in a number of countries, maybe except for the UK that actually offers a refundable credit. All right, so let's maybe get to compliance then. So what are the general rules for the Globe Information Return and the QDMTT return?
Yeah, they're consistent with the model rules. So the GAAR and the domestic minimum tax and IIR return will be due generally 15 months after the end of the year or 18 months for the initial year. So I think that's standard. Did you want to talk about penalties? Penalties I found were very interesting.
Yeah, tell us about those.
More aggressive penalties than we're used to seeing in Canada. So the penalty for failing to file a GIR on time or interestingly, if what is filed is not considered substantially complete in the eyes of the minister, is a $25,000 per month penalty for a maximum of 40 months.
Oh, wow.
Yeah. Very significant.
Yeah, one of the things that I found interesting, well, at least from this Canadian legislation, and maybe I haven't been as focused on it, is the timing of the qualified domestic minimum top-up tax, because I don't think there was sort of specific for their compliance return. And that Canada's chosen to follow the same as the Globe Information Return, but I believe that jurisdictions, frankly, have a lot more leeway as far as how they do that. And it'll be interesting to see whether jurisdictions, and Canada's obviously said that they're going to follow the Globe Information Return, but I think the other potential possibility is that they follow their own corporate tax return deadlines. And that could be meaningfully different in certain territories, and again, just makes the administration and compliance more challenging. Other thing that I wanted to note on the compliance is that the statute of limitations period is 7 years.
7 years, yeah, and then taxpayers are required to keep information for 8 years.
Okay. So As you had mentioned earlier, but I think this is really important for listeners to understand, is that comments are due by September 29th, 2023. I mean, one of the things that we try to advocate here on the Cross-Border Tax Talks, whether it's for taxpayers, advisors, and really any and all stakeholders, academics, to participate in this process, because this is really important. Maybe tell, what is your advice for Canadian, particularly companies that could be subject to this insofar as getting involved in the process?
Yeah, absolutely. We do see some certain industry groups in Canada taking an interest, which is really good, and some of the larger clients. I know the firm will be doing a submission. Like I said, this is the first iteration, and like I said, it was Canadianized, so there are aspects that are worded differently than the model rules, and in some cases we think maybe it doesn't say exactly what they meant to say under the model rules, so we do anticipate a pretty healthy round of submissions for the first round, and then another round of draft legislation.
Yeah, and I think that is really going to be important for each of these jurisdictions as they kind of localize the rules. It seems from the discussions that we've had with a number of different international folks that the general intention is to follow the model rules for both the IR, the UTPR very closely, because they want them to be qualified, understandably. But as each jurisdiction localizes these rules, that we start to notice that, well, this is a substantive difference. Was that really intended? And I think that this comment period will help identify those, and then we can learn, well, were those intentional policy decisions? Was that, we hadn't really considered that?
That's right.
But it's just going to make a real challenge, particularly for those of us that are building the rules, and for those taxpayers that are trying to comply, really understanding, unpacking those differences.
Right.
All right. So I want to move now from Pillar 2, and that's one of my favorite topics, to one of my, frankly, bigger concerns, which is digital service taxes. We haven't given a lot of airtime here on the Cross-Border Tax Talks to Pillar 1, just given a lot of the uncertainty, and we've certainly had a couple of podcasts. But maybe give us a little context, because Canada reproposed, or I guess sent out their most recent version of these rules, and as part of the same package on August 4th, 2023. But this actually goes back, to my understanding, back to December 2021, when these were originally proposed. So tell us a little bit about the DSTs.
Yeah, we'll walk a bit through the timeline. You're right. December 2021, Canada came out with our first draft Digital Services Tax Act. And then you'll recall the rest of the world, or the OECD and Inclusive Framework, entered into the standstill agreement, I call it, that's not the official term, where the parties agreed to hold off implementing new DSTs until they're waiting to see if the Pillar 1 was enacted by the end of 2023, which at the time I guess looked possible. Now
that it's almost the end of 2023.
Fast forward till now, I think that original standstill agreement, people realize, is not gonna work. So they negotiated another extension to that, which 138 countries signed on to. But in a somewhat surprising, I guess, Development Canada has decided they're not going to agree to the extension. They're going to hold firm on the initial agreement in their mind.
I was very surprised by that.
It is a bit surprising. I can, maybe see the reasons. They thought they had a deal, and the deal has changed. But I'm not sure there's a lot of thought that went into it. So Canada has decided not to extend like the rest of the 138 countries in the Inclusive Framework, and is going forward with its rules. And its rules right now, the one that was released in August, not a lot of change since December, some tweaks, not a lot of change, but they're meant to be expected to be effective January 1, 2024. And the real catch with our rules is that they're retroactive back to January 1, 2022 on digital services revenue earned since then. So
two full years.
This is another example of something's going to be enacted, but tax is going to be owing after it's enacted from 2022 and 2023 onward.
All right, so remind listeners what does this do? It's a 3% tax, but tell us a little bit about it. 3%
non-income tax on digital services revenues. I think that's similar to a lot of other DSTs have been proposed. The threshold is not the Pillar 1 threshold. Sometimes people get confused on that. It is the €750 million group revenue. and over 20 million of Canadian source digital services revenue.
Okay.
So
yeah, so it's interesting. They borrowed from the Pillar 2 threshold, which I did find a little interesting, as opposed to using the threshold that would otherwise be prescribed in Pillar 1.
Yeah, yeah, and it's on digital services revenue, which is defined in the Act. It's income from advertising, digital advertising, social media,
marketplace services, and sale or licensing of user data. So very broad.
Yeah, not as broad as Pillar 1.
Fair enough.
But yes, broad.
Broad from a digital services.
With a much lower threshold.
Okay. So something to keep an eye on, and I mean, it will be interesting to see how other jurisdictions react to this potential digital service tax.
We've seen a lot of reaction.
Yeah.
and I think from within and outside of Canada.
And we know how if prior performance is indicative of future results, we know, at least during the Trump administration, when France introduced the digital service tax, it sort of created a mini trade war. I don't even want to call it a mini trade war, a trade war. And so something to obviously keep an eye on to see how the US or any other jurisdictions could potentially respond. I think the general thinking amongst many US multinationals is that Pillar 1 was intended to focus, and these DSTs, on the major tech companies that are often based in the US. So we're going to be very interesting to see how that shakes out.
Yes, it is going to be interesting. I mean, one of the thoughts I've heard is that could Canada help diffuse the situation by making it refundable to the extent Pillar 1 does come in? I think that's going to be difficult to do, given the different thresholds and different population of companies that this is applying to, but.
Oh, and that is fascinating. And what happens if Pillar 1 takes 2 more years? I mean, at the pace, and then generally governments and fiscs aren't that excited about
a lot of speculation.
Sending checks. So that'll be interesting. Okay, so let's move into your interest limitation rules. And so first, I think important for listeners, it's important for people to understand that Canada has now been a part of the creative acronym club, right? We've got, the US has our GILTI, we've got a number of the acronyms in Pillar 2, but the excess interest and financing expense limitation are the EIFEL rules.
Right.
So can you provide a little bit of historical context on these rules? And there's been some question about when they were actually going to come in, and we can unpack a little bit about what they are.
Sure. Yeah, this is Canada's answer to BEPS Action 4, right? So these rules, this is the third iteration of the rules. So these rules, sometimes I don't really think of them as new anymore. This is the third iteration, and at this point, they're pretty much final. So one of the most common questions I get is, will these be deferred? Like, are they really coming this time? And the reason they're asking that is because some people may recall that when they originally were released, they were going to become effective for taxation years after 2022. So for calendar year 2023, they got deferred to taxation years starting after September 30th, 2023. So for calendar 2024. So that's why the rush to get them enacted and the rush to get them. Again, I'm not sure there'll be the fall bill that will enact EIFEL rules will be enacted by October 1st, but I would expect so this fall. And the rules will be applicable. And
it's a EBITDA-based test, generally 30%, is that right? But there was some confusing aspect of that where it said that there was a 40% for tax years beginning after or on, I guess, October 1st, 2023 and before 1/1/24, which felt like an extraordinary small window to have this 40%. But why was that the case?
It does sound funny now. So that I call it a hangover from the initial rules. So when the rules were initially released and they were going to come into effect in 2023, there was going to be a transitional year of 40%. And I think with the deferral of the rules to 2024 effectively, part of the cost of that was a shrinkage or the elimination effectively for calendar year taxpayers, I think, for the 40%. So basically it's a 30% of EBITDA rule for all intents and purposes.
Okay.
Now.
Yeah, and I'll note that there was a carry forward as well. So if you have excess interest expense, that can be carried forward indefinitely. And then if you have excess capacity, that has a 3-year carry forward. So just something important to note, particularly in the context of setting up deferred tax assets, depending on what accounting system you're under, and potential impacts on Pillar 2. Obviously, all of this can impact Pillar 2. Any advice for companies, or what should companies be considering in the context of these interest limitation rules, knowing that they're coming online here now very, very soon?
Yeah, lots. I mean, one thought you had, just to follow up on your previous point about the impacts, is one thing we're seeing is entities in Canada that have a lot of losses because they've borrowed externally in Canada. As a result of the EIFEL rules, their ability to claim interest deductions, say, in excess of income is going to be constrained.
Sure. And
they have to start using these losses. So one thing we're seeing is some companies in that situation are going to be forced to recognize losses for accounting purposes that maybe weren't otherwise recognized. So that is something that people from an accounting point of view have to think about soon, very soon. But the two things that I bring up that we're finding with companies that are the most challenging with the rules is, one, we still don't have consolidation in Canada. So the EIFEL rules are complicated because, one, they're very formulaic, very complicated, but you have to apply them entity by entity. Even so, if you have a large Canadian group with multiple Canadian entities, you still have to apply them entity by entity and think about which entities need excess capacity from which other entities. You can share certain things, or certain elections you can file, right, for maybe even loans between CanCos to be ignored. So even we're finding situations where, on a consolidated basis, maybe the interest is less than 30% of the consolidated adjusted taxable income.
Sure.
You can still end up with problems if you don't follow the right elections. So that's a challenge, is what we're finding is getting the necessary detail. So modeling, again, one of your favorite topics, I think.
Right.
Modeling, extremely important. The other area I'd touch on that has proven to be challenging is, one of the reasons they amended the rules is because they plan to bring in some interest and financing expenses from CFCs of CanCos. So to the extent CFCs of CanCo have interest and financing expenses, you actually are forced to bring those into the domestic calc to calculate your interest limitation. And that's a big challenge, because if you have a lot of CFCs under Canada, you may or may not be tracking these interest and financing expenses. We call it, often they're referred to as foreign accrual property losses, or FAPLs, and they can affect your domestic calc. So we're finding that is a challenge, to go back and figure out, okay, where do we have FAPLs? What are they? Are we going to use them? Are we not? Are they going to affect our calc? The new rules have an election, which can let you defer the portion of that if you don't want to use the FAPLs, but it's complicated. So those two aspects of the rules, I think, are challenging.
Yeah, it's interesting. So it sounds like, particularly for Canadian multinationals, they may need to add some of this additional information that they need under the EIFEL rules to all this additional information they're going to need to be able to do their Pillar 2 calculations.
Yes.
Right? Because if some of this information generally isn't reported up, that obviously is a big challenge for Pillar 2, and something that Canadian MNCs should certainly be focused on.
And additional reporting. It comes with additional reporting around.
Okay.
It's not just a number you plunk on your tax return. There's going to be reporting around all the data required to do your EIFEL calc. So
okay, so additional forms or statements or whatever
Correct.
that may be attached to the Canadian tax return.
Yeah.
Okay, so let's move to our last topic, briefly on the Canadian General Anti-Avoidance Rule.
Yes.
Maybe provide just a little bit of framework, because Canada's had its GAAR, and then there were a couple of notable proposed changes in the August 4th. So maybe start with a little bit of framework and a little bit of history.
Yeah, Canada's had a GAAR for a long time, I think since 1987. And we've, generally, if you talk to most practitioners in Canada, they'd say it was working well. We'd gotten to a point where we kind of understood there's a lot enough jurisprudence at the Supreme Court level to understand how to apply it. And just to remind listeners and viewers that how our GAAR generally works is you have to have a tax benefit. If there's a transaction that has a tax benefit, and it's an avoidance transaction, which generally means, under the current rules, the primary purpose is not to is to get the tax benefit, not for bona fide purposes other than to get the tax benefit. So if you have an avoidance transaction, the GAAR would apply if it's considered a misuse or abuse of the provisions of the Tax Act. That's kind of the current rule. That's the framework.
And then there has been some changes then, specifically first with the purpose test, and this is a significant change. So how did the purpose test change?
Yeah, the purpose test was a primary purpose test. It's been changed to one of the main purposes tests, which is obviously broader. That's something that clearly the government has put in because it thinks it can capture additional transactions. So that's an important change. It also added a preamble to GAAR, which even the explanatory notes, I think, say doesn't affect the framework of the GAAR, but it's meant to put everything in context. So.
Okay. And then there were also some changes with respect to economic substance.
Yeah, that's probably the biggest change that people are struggling with. So in the release we got on August 4th, there's a presumption in there that if a transaction doesn't have sufficient economic substance, and there's some details in there about what that means and some examples. There's like 3 criteria to look at. There's a presumption that the avoidance transaction is a misuse or abuse, which is different than before. Before, it was generally the Crown who had to prove that it was a misuse or abuse.
I see.
Now, if you just read the proposed amendments, it would lead you to believe that the presumption is it's a misuse or abuse, you're done. The explanatory notes go on to say that it's a rebuttable presumption. So the taxpayer can now, the onus is on the taxpayer now to go and prove that it's not a misuse or abuse. So I think in the submissions you see on that, there's going to be a lot of discussion around, because to me right now there's a difference between what the words say in the Act and what the explanatory notes say around the rebuttable presumption stuff. But it's going to, that probably is the main change. So we haven't worried about economic substance in Canada as much in that way, like where it's officially, making the presumption that it's an abuse or a misuse.
Right, so the comment period, you say September 8th, so yes. Different than the comment period. One important thing to note for listeners is that this General Anti-Avoidance Rule also applies for the Global Minimum Tax Act in addition to your Canadian Income Tax Act.
That's right, yeah.
And then what are the penalties, or if a taxpayer would be subject to these GAAR rules?
Yeah, they did add an extra penalty provision where there's a 25% basically tax of the benefit, equal to the benefit. So that's a bit new. So it's what it takes away is the nothing ventured, nothing gained kind of mentality that some taxpayers may have had in certain circumstances. So now there's a real tax cost potentially. Okay.
And then a 3-year extension of
yes.
the reassessment period just to kind of toll the statute of limitations.
Yeah, and you can avoid that by filing a disclosure with the government under our mandatory disclosure rules. So that is one thing to note, that if you do disclose either under our MDR rules or voluntarily, you don't fall within those penalty provisions.
Well, Ken, this has been a fascinating discussion. I mean, it's just amazing the amount of just how dynamic international tax is, frankly, everywhere. And yeah. I mean, there were other stuff that Canada, and we talked about the hybrid rule. I mean, there's a lot of other things, but wanted to kind of cover some of the highlights or lowlights, I think maybe depending on a taxpayer's perspective with respect to some of these rules, and particularly some of the compliance challenges around Pillar 2 and the EIFEL rules, which I know is really, really challenging for both taxpayers and advisors. So thanks a lot for coming on and shedding some light. We'll make sure that we continue to track this, and as these rules get introduced, we'll bring you back specifically to talk about Pillar 2 and see how some of these questions might be answered.
Excellent. Thanks, Doug.
So thanks for tuning in to this week's episode of Cross Border Tax Talks. Thank you, Ken Buttenham, PwC Canada's International Tax Services Leader. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.